folks. I'm Sam Chandan, the Silverstein Chair and Dean of the Schack Institute of Real Estate at the NYU School of Professional Studies. Thank you so much for joining us again today for the next in our series this summer, the Summer 2020 REIT Leadership Workshop. Really delighted to have you here. I'm thrilled to co-host this program each week with my colleagues Robin Panovka and Adam Emmerich, the co-chairs of the REIT M&A practice at Wachtell Lipton. Both are also board members at the NYU REIT Center, and Robin as well is a board member of the Schack Institute. I'm also joined by Scott Robinson, my colleague and friend, professor at NYU, and the director of the REIT Center at the university. I want to take a moment to thank Monmouth Real Estate Investment Corporation. Monmouth and Mike Landy are stalwart supporters of the real estate program at Schack throughout the year and have sponsored this series, which has allowed us to make additional scholarship and financial aid monies available to students impacted by the pandemic. And we appreciate Monmouth's contribution, that of all of our supporters. It's made a real difference for a lot of students, as you could imagine. This series has been amazing. We kicked off with Sam Zell on July 8th. We've followed up in the weeks subsequent. Hamid Moghadam from Prologis, Debbie Cafaro last week from Ventas, Sherry Rexroad from BlackRock the week before that, Mike Kirby, co-founder of Green Street Advisors, Ron Havner from Public Storage, just a really amazing roster of folks. And many more to come. If you missed any of our guests, you can catch all of the replays on Schack's YouTube site, youtube.com/NYU Schack. And of course, next week, we'll be joined by Leslie Hale, the CEO of RLJ Property Trust. We're really excited for that, so please don't miss it. We have some amazing plans in the works for our fall series, and so keep an eye out. Over the next couple of weeks, we'll be announcing the next lineup of speakers and an expanded set of programs on both Tuesdays and Thursdays come this fall. Today, of course, we are joined by Hap Stein, an absolute legend in the industry. And Adam in a moment is going to do Hap's formal introduction. I'll only say that Regency Centers is indisputably the premier national owner, operator, and developer of shopping centers, serving primarily affluent consumers and communities. They have more than 400 assets around the United States. I know that everyone is very eager to hear about how they are navigating the pandemic, as well as some of the larger trends shaping the retail sector. With an eye to that, before I hand it over to Adam, just a very quick reminder, please use the Q&A feature, which is enabled in Zoom. If you're watching on the live stream platform on YouTube or Facebook, you won't have that option, but if you're in Zoom, please do use the Q&A feature. We've also enabled upvote, so if you see a question that you really like and you want to make sure that we ask, hit the like button, that upvotes it. The most popular questions rise to the top of the list. But with that, let me hand it over to Adam to introduce Hap.
Hap, it's a real pleasure to have you with us today. You're as Sam said, you're a real luminary in the REIT world. If I'm not mistaken, you joined the predecessor of Regency in 1976, and you were there as CEO from the time of Regency's 1993 IPO. So you've really seen the entire arc of the modern REIT era. And again, as Sam said, growing Regency into what it is today, an S&P 500 company, $11 billion of assets, your leadership in NAREIT and in ULI, your relationships across the industry and the kind of company that Regency is in every respect in operations. I, of course, prepared a little bit for our chat today, had an opportunity to read through the Q2 earnings call. Just a really impressive story of growth over the decades and of resilience during the recent COVID era. So we're super thrilled and proud to have you with us today, and I'm sure we're in for an interesting conversation. So thank you again for being here, Hap. Just to jump right in, as I mentioned, as a public REIT, you've led Regency from the time of the IPO in 1993, just on the heels of what we perceived at the time, at least, to be kind of an epic real estate crisis, through the great financial crisis, and now through the COVID pandemic. In terms of lessons learned and lessons applied during the COVID pandemic, is it sui generis? What can you tell us about REITs and REITs of your particular type, property type, during economic and real estate crises?
Well, number one, I think it's pretty obvious that in my over 45 years in the business, never experienced anything like this. I mean, we have and hopefully it is 100-year pandemic. We've shut down the economy for an extended period of time, and we're in, what's probably going to be a long, slow recovery. We've taken divisiveness in the political arena up to a new level. Back to the pandemic, if you compare our country's response to it with other developed countries, we haven't done that well. So it's been a witch's brew, but at the same time, I mean, we've seen massive intervention on the part of the Fed, which has kept interest rates low. We've seen a bipartisan CARES Act that was passed that have helped struggling businesses that have needed the help and the unemployed. But I think that the lessons learned that we learned, from, in effect from the Great Recession, as far as, enhancing the balance sheet, making sure that, because you never know what's going to happen, but having a strong balance sheet is going to be really important, and a low payout ratio from a dividend standpoint, and right-sizing a development program, and continuing to enhance the quality of the team. And I think that as a result of that, Regency, and I think most other REITs, were much better prepared, and thank God we were, going into this downturn than we were into the Great Recession, with those lessons learned and being better prepared. And I think as a result of the quality of our portfolio, and I'd say this a lot of our peers, the quality, especially the quality of our balance sheet, a low payout ratio, we were able to absorb a very significant body blow, and I don't want to underestimate that, to the shopping center sector in general. That included Regency in particular. We're able to, the board believes that although we're going to carefully monitor it, that the dividend is sustainable and basically fully covered at this point in time. And we feel like our net operating income is stabilized and heading in the right direction. And we're also seeing, we're blessed with the fact that 80% of our shopping centers have grocery anchors, and the grocery stores, as everybody has read, are performing exceptionally well. And half of the remainder of our centers are anchored by mass merchandisers like Target and Walmart or Home Depot and Lowe's. And 60% of our tenants are essential tenants, including essential restaurants and service providers. So we've been, 95% of our centers are open, and we're finding that stores that are opening are doing better than they expected to do. So, knock on wood, I think the community and neighborhood shopping center sector of REITs, which is better in general, the quality of those are better than in general than the 45,000 plus shopping centers that are out there. And I'd say Regency in particular are going to be well positioned, especially I think those, being close to the shoppers in the neighborhood and communities, and convenience and necessity and value are going to continue to be important. And also I think that omni-channel and bricks and mortar is going to continue to be critically important, as indicated by, Amazon's plans that have been announced to expand in the traditional grocery business, and many other e-commerce retailers.
You look at some of the statistics that you cited, which, are public statistics, obviously, like 95% open and continuing the dividend at the same level in Q2 and so forth. I mean, obviously there was a huge disruption and a huge dip, and some of the things you talked about, though, also in your earnings and otherwise, and local operators and national operators taking advantage, not taking advantage, but I mean, you know, adapting to the situation with outdoor exercise classes or
Right.
extended hours for nail salons and things like that. It feels like, you know, does it feel to you like you're past the worst of this, or is that unduly optimistic?
The answer to that is yes. I think that we're hopefully in the bridge to the new normal, and I think that for the most part, our government, but the people in our country, for the most part, and companies are learning how to live with COVID. COVID's here, and and we're in a slow recovery. And I think any business that is, we may get a vaccine sooner rather than later. It could be some sectors of the economy, like housing, are in a V recovery, but most sectors that is not the case. And I think that we need to plan on a slow recovery, living with COVID, living with masking, living with restaurants that are 50% open. Restaurateurs, the really good ones, are providing delivery, takeout service. We're providing curbside, as you mentioned, outdoor for a lot of the fitness operators. So we're learning how to live in this what could be a long, but it's a recovery, and we are in a bridge, and I think that things are moving, knock on wood, in the right direction.
Hap, you touched on the quality of the Regency portfolio compared to the 40,000 centers out there, and obviously that's indisputable, and it's part of what's fueled the company's great performance and growth. And a lot of that has to do with places that have drawn more affluent consumers, and particularly big cities and their surrounding areas. Do you think we're going to see a long-term impact in terms of, you were talking before we began about the real estate market out where you are in Colorado. Is there going to be a long-term demographic shift away from cities and near suburbs and places like New York and San Francisco?
On the one hand, you're betting against New York City is. People have done that, and New York's faced many, many crises. But at the same time, I think what the dense urban areas are facing, I think, are kind of three issues that are going to have a headwind, a meaningful headwinds. I think number one, and not necessarily in this order, but the perception and reality of security or lack thereof. I think that. Number two, I think you've got governments and local governments that to date have been anti-business. Three, you have mass transit. And we were talking earlier about mass transit is probably pretty safe right now because a lot of people aren't using it, but that isn't necessarily what you want to see. And I think fourth is elevators. And I think there's going to be a trend for the foreseeable future, where I think the affluent suburbs, near urban areas, secondary homes are going to benefit from that. And I really do believe that Regency's portfolio, as you indicated, and yours and Sam's too nice introduction towards the affluent suburbs. I think there's going to be a little bit of a movement, even from a metro standpoint, away from some of the gateway markets. So some of the non-gateway markets are going to proliferate or do better. So I think those trends, whether they're long-term or not, I think we ought to. That's a scenario that has a high likelihood of occurring over the next for the foreseeable future.
It's interesting, and it's frightening for those of us living in New York. I have to say, we'll do our best to get through this. You sort of, to switch gears a little bit, Regency has done a fair bit of M&A, including some quite large scale deals. There was a huge dip in M&A, generally speaking, this year, obviously during the trough of the market reaction to the pandemic in March and April. And M&A, not necessarily in real estate per se, but across the publicly traded corporate sector and PE sector has come back a bit in the last couple of months. Do you see a lot of REIT, and particularly not to give away anything about Regency itself, obviously, but do you see M&A being a big factor in the REIT world and in your property type over the next 12 to 18 months?
I think you could see some, but I think that from Regency's perspective, and I think if you look at successful M&A deals that have been done out there, while bigger may be better, better is always best. And that's the question that every REIT board and every REIT CEO and executive team ought to be, asking themselves, are there going to be opportunities that are going to really make us better? And when we look back, we kind of got spoiled with the Equity One transaction and other transaction because strategically it enhanced the quality and demographics of our portfolio, NOI growth rate. We picked up a robust redevelopment pipeline. Our balance sheet was enhanced by the fact that we were added to the S&P 500 and we were able to do a 30-year bond offering immediately after the transaction. There were significant synergies, so the transaction was accretive to earnings on essentially a leverage neutral basis. So I think those are the criteria that we're going to be looking at. But having said that, I do think it's, in general, it's a little early. I think there's a lot of dust that needs to settle as far as what's happening, I think, in general is related to COVID and particularly in our sector. And also, I think that this is really an important time for teams to block and tackle, make sure their balance sheets are back where they need to be. And that's what the focus that I'm going to encourage Lisa and the team to do. And I'm going to segue into that because I think that she, as many of you may be aware, I became, I know it's one of the questions you were thinking about asking, but became executive chairman January 1. And I couldn't be, as one of the most proud things is being in my too many years with Regency and 27 years as a REIT CEO is how well the succession has gone. I knew she was good, but the leadership she's demonstrated during this crisis and the executive team and all of our employees has been incredibly gratifying. They're doing a great job.
It has from the outside, it certainly has looked like a great success. Can you talk a little bit more about the transition to executive chairman? Obviously, there are a lot of different models out there in terms of, CEO transition, board composition, succession planning. Was your transition to executive chairman long planned and executed according to kind of a succession plan?
The answer is yes. I mean, the board, to the board's credit, spent an extensive and rigorous amount of time going through succession planning. We hired a consultant that helped us and helped the board with the process. We did 360 interviews for all the executive team. Not surprisingly, the 360 review of Lisa showed significant leadership skills, great followership, great talent, et cetera. And so it was and she's been with the company for over 20 years, fully understands our culture. That was incredibly important to the board and to me. And so I think that was a process that's, showing that it's ended up, it's going to be terrific. And she's going to build on the past successes, and the team are going to build on the past successes. But obviously one of the issues with succession, especially where you have an executive chairman is number one, and our board was very, very sensitive to this, there can only be one CEO. And the executive chairman Where it has failed is where the executive chairman has tried to preempt or even sometimes undermine, either by perception or reality, the responsibility and authority and the role of the CEO. And having been a CEO, I was very, very sensitive to that, and the board wanted to make sure that I was sensitive to that. And I think that also Lisa and I have had, over the 20 years she's been with the company, a great working relationship. And knock on wood, I think that hopefully I've been helpful to her in bouncing strategic ideas and ideas off, in discussing those with her, and help with that. And hopefully I've helped with the, working with the board. But, so far although it seems like it has only been 7 months, but it seems like 7 years.
A long 7 months that you picked for this transition.
But it's been a lot of fun. And as I said before, some people, I feel for her having had this pandemic and recession, et cetera, thrown on her, but it really has given her and the team an opportunity to show their mettle.
Yeah, no, it looks from the outside like a very, very successful transition. Are you personally, are you a little restless, or you're enjoying it?
I've actually been pretty involved in the company, and I think I've been involved in a non-invasive and supportive way. And supporting Lisa and the team is my primary responsibility, to me, and chairman of the board. So that's, this has been pretty interesting time. So that's been very involved there. And I've gotten involved, I know we shouldn't talk about politics here, in this group called No Labels, which supports the Problem Solvers Caucus and the of 25 Republicans and 25 Democrats in the House, bipartisan group, and a similar group in the Senate. So those things, plus enjoying myself and enjoying Colorado right now a little bit more than I have in the past.
That's great. You touched on something before when we talked about M&A, which is, quality and is indisputable. And obviously what you said about the Equity One deal, it's hard to find a deal that lines up the stars quite as much as that. So we're not counting on you to find the next one necessarily. But let me ask you a related question, which has to do with something that Sam Zell has talked about a lot. We mentioned the 40,000 centers. I don't know what portion of that in the property type is held in the public REIT format. Obviously, you have the cream of the cream with your centers. Do you see a migration, whether it's through M&A or otherwise, to a bigger proportion of properties in your sector to public ownership, and why or why not?
Well, I think that what's happened since the Great Recession, Regency to some extent, and I'd almost say the shopping center sector to a greater extent, is there's been, a move to quality. And I think that the shopping center sector today, and this includes Regency, but we started from a better place. The quality of our peers is much better, and the sector in general is much better than it's been. So I would say that I'm taking the 40, 50,000 shopping centers. I would say that the REITs today are in the top quartile of those.
Yeah.
And so, I think you will see some continued migration there. But the other thing that you have that is going on is, starting with retailers, you've got this separation between winners and losers. And that's going to continue. This COVID crisis and the economic downturn has been a great accelerator. And it's going to continue to accelerate not only the separation from the winners and losers, and the winners on the retail side, but it's also winners, commodity assets, and irrelevant shopping centers on the retail real estate side. Mm-hmm. And so we have too much retail, but the portion that's owned by the better shopping center companies, and I put most shopping center REITs in that category, mm-hmm. It's a smaller slice of that pie. So I think that, and I'd also say, not only from Regency's perspective, strong belief that while bigger may be better, better is always best. I think most of Lisa's fellow CEOs and our fellow boards in the shopping center sector would be adherents to that.
Yeah, very interesting. You talked about obviously retail failures, and it's been in the press a lot, particularly with the regional mall type retailers and the deals that have been made for, or that are talked about being made in some cases for J.C. Penney, for Forever 21, for Brooks Brothers, and so forth. Does that kind of realignment hit you as hard as it does the enclosed malls, or what is it? You're just so much more involved with local, more essential service type retailers that it isn't as big a factor for you?
Well, Adam, I'm not sure of your question. Whereas Kimco has successfully over time bought boxes in bulk, that has not been a strategy that Regency has adopted. I mean, we've wanted to buy, and where we've been successful is buying community and neighborhood shopping centers with sustainable competitive advantages based upon who the anchors are, based upon affluent and near urban trade areas. And so, and then investing in retailers, even though some of our peers have done that in one fashion or another, especially these strong the restaurants that can become like anchor tenants.
Mm-hmm.
That's something that's a strategy that we've avoided, and we kind of believe that we ought to be more arm's length. I will say that, David Simon and the Brookfield folks are very, very astute. I don't think they're not, so to speak, betting the ranch on J.C.
Mm-hmm.
Penney's or the other retailers that they've invested in. So I'm confident that they're going to do well with those investments, but that's not something that Regency has looked to do.
Yeah, no, it makes perfect sense. I won't press you on the political front, although it sounds like you're on exactly the right track in terms of bipartisan initiatives to make the world a better place. But I will ask you if you want to comment on it, and you touched on the liquidity response. Have you experienced really different consequences or different experiences around the country in terms of state and local government response? Have you seen people adopting best practices? What's the experience you've had with the political impact and regulatory impact of the pandemic?
Well, one of the challenging things that has occurred, and this is from a business standpoint, has been in California, which interestingly enough, the Governor Newsom, et cetera, or in California, governmental seem to be pretty strong as far as not opening up too soon, social distancing, masking, et cetera. Although you would see pointed photographs of people on the beaches in Southern California. But one of the challenges that we've faced is the opening and closing back up and further restrictions that has occurred in California. And not pointing any fingers at the government authorities there. I would just say, in general, and being a resident of Florida and being a resident of Northeast Florida, where Jacksonville is, which was going to try to host the Republican National Convention, enough said there. Unfortunately, that was canceled for the right reasons. I think that, in retrospect, and hopefully in many, you can make the comment, we should have figured this out sooner. Some areas should have been closed down or sheltered in place sooner. Some portions of the population should have been sheltered in place sooner. Other areas, we sheltered in place for too long or not long enough. But when we came out, some people believing it is a hoax. We didn't put in place, wear masks, social distance. And it was kind of poignantly, there's certain sports writers that I like that, and I'm a big college football fan, but they wrote several editorials from several of my favorite sports writers said, wear mask and socially distance so we can have a college football season, you dumb idiots. So, I mean, but it does appear to me that, as I said before, that we, for the most part, the country, I don't think we're going to, shelter in place again. Hopefully not. I think we're learning how to live with this pandemic, but anybody that thinks that it's gone away is smoking loco weed. And I think we've got to learn how to live with it. And I do think for the most part, I mean, you see, pictures of what was happening up in South Dakota. And a guy saw something on television about in China, where they're having big I mean, just kind of like, but why do we allow, and why do people do these things that just, where they're not socially distancing and they're not wearing masks? Because if we do those things, we can continue to keep the economy, continue to open up the economy and move from the bridge to the new normal.
In terms of, your company workforce, obviously people who are involved in property management and supporting
Right.
the businesses that were open in the centers is one thing. Were you surprised at how effective and seamless in a way it was to transition to a shelter-in-place, work-from-home sort of environment?
Well, number one, I think that Lisa and the team have done a great job of focused on the health of our employees, the security and safety of our shopping centers, and then trying to help our tenants open up. And I think they've done a terrific job with that. I think it has been seamless. We started opening back up our offices with very thoughtful protocols in late June, I think it was. We have made going back to work voluntary and not even encouraged it. And it has been seamless from that standpoint. And I do think that in general, work from home will play a greater role in business today, but also I don't think you can be as productive unless you're in person. And so, I think that the sooner that, today we're about 10% in our Jacksonville office where we have 200 employees, and about probably 20% of the remainder of the offices. Some we're getting more attendance than others. Once again, it's on a totally voluntary basis, but we can't be as productive, and we need to get back to as much in person and get back to the new normal sooner rather than later. But that sooner can't be too soon when people don't feel comfortable being at work.
Yep. Yep, absolutely. Well, it sounds like you're handling it really in the 100% right way. Let me just shift gears for a second. One of the things people have talked about a lot, and it's really not news in the REIT world, but it's become bigger news more broadly over the last year or so, and I think particularly during the pandemic, is the whole ESG world, corporate purpose. Do you have some thoughts as far as Regency's orientation on that kind of stuff?
Well, I think that doing the right thing, being good community and environmental stewards has always been integral to Regency's culture. So a lot of this came naturally. We hired a head of sustainability well over 10 years ago. Regency did the first green bond offering. We published our first corporate responsibility report recently. It is a priority as far as the board and management. And we think that diversity, paying our employees well, being environmental stewards, where we've continued to make great progress, but we still in a lot of these areas have a ways to go. Not only are doing the right thing, but we think they're good for business. And once again, my hat's off to the team for what they've done. And I will say that it will continue to be a growing and more important part of the business. And hopefully the key thing is for Regency and other businesses in America to take practical steps that are going to, move forward environmental, social progress and governance progress. And, transparency, getting back to that, is, and Regency's always been, highly regarded, and our compensation practices have been always considered to be very, shareholder friendly. So it's come pretty naturally to us, but it's something that we will continue to move forward and enhance all those practices in time.
It's obviously an area where there's a tremendous amount of interaction with shareholders and other stakeholders. And I assume that given your long time leadership in sustainability in particular, it hasn't been a source of conflict. Do you think, and at the same time, you've actually benefited from it? Have you heard from shareholders that it's a plus factor investing in Regency? Does it impact the stock price? Where does the rubber meet the road, actually?
I think it's one of many. I think that management that do things right, that includes governance, that includes sustainability. I think being involved in the community, all these things I think add up. And I think in the eyes of the shareholder, I think that it's one of those incremental things that make a difference. Now, I do think, I also believe that managements that are on the other extreme, and it's hard for companies that are in the public sphere to be on the other extreme today, that are just paying lip service, et cetera. I think that becomes apparent to shareholders, not just in those regards, but I think it's indicative of the credibility of management. And I think that obviously makes a difference to shareholders. And I think that is part of the premium multiple that Regency has, because we are an industry leader, and we do those things that will continue to enhance our position as an industry leader. And I think that does make a difference. But I don't think today you can point to anything specific in that regard that we can say, well, because of that, we trade at 50 bips better or whatever than we would have otherwise.
Yeah. I see that Sam and Robin are back. We have a huge stack of questions in the chat feature and the Q&A feature from the audience, including a lot of votes. So Sam, should I turn it over to you to hit the first question to find out what people really want to hear about from Hap?
Yeah, thanks, Adam. Hap, the most popular question by far. Not necessarily with respect to anything specific that Regency may be thinking about, but broadly, what are your thoughts on retail owner, operator, developers investing in their tenants, as we've seen in some cases with some very high-profile national tenants in the last couple of months?
So I think, as I tried to articulate to Adam, and I'll try to do a little bit better job with you, Sam, but Kimco in the shopping center sector has bought boxes, and in the case of Albertson, but boxes retailers in bulk, and have implemented that strategy successfully. Simon and Brookfield, who are also very astute investors, have recently bought, and then there's discussion about JCPenney's, but they've purchased retailers. In neither case was Kimco nor Simon nor Brookfield, in effect, betting the ranch. And I think they've got their own reasons and their rationale, which I'm sure from their standpoint makes compelling sense. From Regency's standpoint, and then you've had other lifestyle centers where developers have in effect invested in key restaurants that have been magnet tenants for those shopping centers, either directly or indirectly. And from Regency's standpoint, our strategy has been, let's invest in community and neighborhood shopping centers that are going to be anchored by highly productive and leading grocery stores and highly productive and market leaders like TJX, from a secondary anchor standpoint, and successful restaurant operators that can stand on their own. Doesn't mean we're not going to provide some amount of tenant allowance. And those shopping centers, when you in the right demographic location of the affluent suburbs, you take that formula and it's going to result in a sustainable competitive advantage. And that's been our focus going back for many, many years. And when we've stuck to that knitting, it's worked out extremely well. We've continued to kind of refine what a sustainable competitive advantage means, and where you want to have a shopping center where if bad news happens, it's good news. But that's been our strategy, and it's made sense for us, and it's paid dividends. And I don't see us in any big way. It doesn't mean we're not going to give a tenant allowance to a great restaurant more than we would what you might call a normal restaurant, because we think they may attract more shoppers to our shopping center and attract other side shop retailers. But it's going to be moderated in size, and investing in retailers and restaurants directly has not been part of our strategy, and I don't see that happening in the future.
Yeah, and forgive me for bringing the question back to the table. After your teaser comments about Kimco earlier, I think the people wanted more. And so it quickly
That's okay.
became the most popular
After
question
your
we've
generous introduction of me, you can ask me anything you want to, Sam.
Fair enough. Robin, you've got the next question.
So another category of questions revolves around the notion of redevelopment, both in terms of your properties, which are better located, and maybe the other 40,000 or 20,000 or whatever it is that are that are less well located. What do you see happening to those properties? Do you see your properties getting densified, the other properties being bulldozed down? What happens with all this excess retail?
So I can't speak to something's going to happen to the excess amount of real estate, whether it'll be other uses or maybe what I call lower rent retail uses, maybe fulfillment centers. I'm not sure, but if you focus on the top quartile of shopping centers, renovating shopping centers, putting on a fresh look, and making the design and placemaking relevant to today and merchandising relevant today. We have this philosophy called fresh look from a merchandising and from a placemaking standpoint. I think that will always be part of our playbook, an important part of our playbook. And we think that part of our sustainable competitive advantages of our shopping centers is their, the relevance, their fresh look of the merchandising, the design, et cetera. And that's going to be an ongoing process. Not a significant portion, I don't know whether it's 1% or 5% or maybe 10%, but it's less than 10% of the 40,000 shopping centers are going to have meaningful densification opportunities, where I would call accretive densification opportunities. Those are really, really hard. They take a lot of time. In many cases, you're taking down net operating income. And in Regency's case, if it involves non-retail uses, I mean, if you've got an incidental amount of office space, we'll do it ourselves. If we got an incidental amount of apartments, we'll do it ourselves. But if you're talking about a meaningful portion of the shopping center becoming office or life sciences office or apartments, it's been our belief to date, what we want to do is we want to have a partner in there that has meaningful expertise and meaningful capital. And I would say I even feel even more strongly about that, given the amount of time, the difficulty and the challenges of that today. But some of that's going to happen, and some of that's going to be, accretive to our shopping centers and accretive to those that other owners have.
But before Scott jumps in with a question, folks in the chat panel, I just added a link to the Fresh Look site on the Regency Center's webpage, so you could read a little bit more at your leisure about that strategy. Should also mention, I know we have a number of folks that may be at universities around the country or colleges, maybe some folks who've just graduated. I took a quick look earlier at the Regency Centers website. There are actually a number of positions that they're advertising in areas ranging from property management to the investments team in all different parts of the country. So I'm going to include a link to that as well if you find yourself in the market. Scott.
Thanks, Sam. Hap, the COVID containment efforts are obviously having a far-reaching economic impact across industries and operators. What's your outlook for the smaller mom and pop kind of inline retailers? Do you see that universe shrinking? Are you going to be looking to provide economic support to them through more free rent, TIs, LC, et cetera?
It's going to be, one thing that I've learned in my 45 years of business is business is not binary. It isn't just, every restaurant's going to fail, and some are going to succeed. So of our restaurants, we have, I think I mentioned this, we have essential restaurants that are essential restaurants like Starbucks, McDonald's, Chipotle, fast casuals, and those restaurants either have some combination of very strong financial conditions themselves, and so they're and for the most part are doing pretty well. Then on the on the other side, you have fast casual local restaurants, and even restaurants with table service. Table service restaurants are those that are being impacted, most adversely impacted the most. But a lot of these are local entrepreneurs, and they are being very creative, with their, and many of them, and I'd say the majority of them are going to succeed. They're doing takeout service, they're doing delivery service, which obviously has its a cost to it, and they're expanding their outdoor seating. So these are creative entrepreneurs. Most of our local shops are not just one shop. They typically have several in their chain, and they have decent financial statements. I would say also that the PPP, I don't know that the majority have taken advantage of PPP, and I do think that part of the CARES Act, for the most part, these government programs can't be perfect, have allowed small businesses to survive and to pay their employees. I'm aware, interestingly enough, of a chain of Applebee's, not a tenant of ours, that has 60 Applebee's restaurants in markets that Regency's not there, and received a pretty significant PPP loan that's allowed them to rehire all 3,000 employees. I think that's what the Congress had in mind for PPP, but they've also, getting back to my key point, creative, smart enough, good enough financials to, outdoor seating, delivery, and pickup, and doing well within the 50% seating inside.
A quick follow-up on your point about PPP. Of course, as you described, government programs never being perfect. Certainly in late March, early April, while some aspects of the CARES Act might seem like, with the benefit of hindsight, blunt instruments, we had to move very, very quickly with very little information about how the pandemic would unfold, what its economic impact would be. And so there wasn't necessarily an opportunity to be as strategic and as targeted with these programs as we might have been if we had had the luxury of time. That said, in the last few weeks, we've seen some elements of the CARES Act expire. A lot of focus has been on things like eviction moratoria, the enhanced unemployment benefits. People have certainly, spent a large part of, if not all, of their economic impact payments, the stimulus checks. Does another round of support become important, whether it's targeted to consumers, supporting state and local governments? Is that important for us as we think about the trajectory of the economy, the unfolding of the recovery later on this year?
Whether you want to call it necessary or an insurance policy, I would say the answer is yes. I think the country may have some long-term issues with the deficit, but we need to get through this crisis. I think that $3 trillion seems like excessive to me. I know that the Problem Solvers Caucus and No Labels are working for some type of compromise legislation that involve things like liability reform, providing aid to city and local governments, but would not, in effect, paying for past sins of these governments where they've made, So I think that I think the answer to your question, Sam, is I'd be supportive of it, and I'm supporting No Labels and the Problem Solvers with coming up with a thoughtful, targeted approach for some, a follow-up on the CARES Act.
So Hap, category of questions that have come in relate to kind of the long-term plan. You have at Regency, and maybe broader than that, and how it's being affected by COVID. You mentioned earlier that COVID has been an accelerant of a bunch of technological and other trends. Does it change the way you think about the next 3, 4, 5 years, or not? How do you think about that?
For sure. I mean, I think that the design of our shopping centers are going to incorporate more which we're already doing, curbside pickup. We're going to probably be more lenient with restaurants as far as, serving outside, and also to fitness studios doing that. And I'm sure there are going to be other, components that will be incorporated into the design of shopping centers. We're always working to keep our merchandising in general and our placemaking from relevant through our fresh look, philosophy. And I think as Lisa and the team and the board thinks about our strategy on a go-forward basis, I think we want to make sure, there's different scenarios that can be out there, both from what's the impact of the economy, what's the impact of technological change, e-commerce, bricks and mortar, on retailers and on shopping centers, and who the winners and the losers are going to be. And we're going to need to continue to be, close to who we consider to be the better retailers. But I think a few things are going to help us no matter what the scenario is going to be out there. And the future's uncertain. But I do think that a balance sheet, and a strong balance sheet, is going to continue to be a competitive advantage for Regency. I do believe owning shopping centers with sustainable competitive advantage and being, in effect, partnering with best-in-class retailers is going to continue to be a key, a playbook that's going to work no matter what scenario that occurs there. I do think having a top-notch, engaged management team that's guided by a special culture is going to allow you to attract and keep and retain top-notch talent, which is going to be critically important as you navigate through the bridge to the new normal and the way this business is going to evolve over the next 5 to 10 years. I think that's going to be there. And I think making sure that our development program, our development capabilities, we're using those, but using those in a way where you can start and stop projects a little bit, have a little bit more flexibility there, where we're partnering with the right partners from an expertise and a capital standpoint on these mixed-use projects. And we're not taxing the balance sheet, because the balance sheet is going to allow you to invest in your existing properties, to invest in developments, and when those extraordinary opportunities arise, to take advantage of those opportunities. And so whatever the scenario is, I think, and whatever our strategy might be for the next 5 to 10 years, I think that when you have this discussion with Lisa or Lisa's successor 5 or 10 years from now, you'll find that to be part of Regency's strategy.
Well, we're recording this program, so we'll play it back for Lisa's successor and see what they say. Adam, back to you.
I think we're nearing the end. I guess we have time for maybe a couple more questions. One question which we didn't really touch on up till now, which people in the audience have asked, is what about going private transactions? Do you see that as something we'll see in the in the year ahead?
Well, I mean, going private transactions, the question isn't whether there's going to be going private transactions and there's going to be M&A transactions within the sector or outside of the sector. And there's going to continue to be that. The question is, are they going to accelerate beyond, at a faster pace than historical norms? And it's possible, but I don't see anything out there that's going to say that, the strong sectors, those companies are trading at pretty strong, pretty high premium multiples. And you have sectors, and I'm not going to talk about ours, but the hotel sector, I mean, I'm not sure what, you don't know what's going to happen, so to speak, in the hotel sectors. And you have, you got all the way from extended stay in the hotel sector to those companies, if any of them are, based upon, these big event hotels. I think it depends, but I don't see, Adam, answer to you. It could happen, but I don't see. If I were a betting man, I would bet that it would be, kind of, we return back to normal, kind of within a 5 or 10% range of M&A transactions.
Yeah. Well, thank you for that. Sam, do we have time for another question?
We probably do not, but to Hap's point about the uncertainty in the hotel sector, this would be a great point as we wrap up to mention that we do have Leslie Hale with us next week from RLJ Property Trust. So we'll get some insights into what's next for hospitality. But Hap, on behalf of everyone at NYU and in the real estate community at large, for joining us today, but also just for everything you do for the industry, your work with the Real Estate Roundtable over the years. You're joining us each year for the NYU REIT Symposium. Just cannot thank you enough.
Flattery will get you everywhere. Thank you very, very much. It's been a treat dealing with working with all of you guys on this call and throughout my career. Thank you.
Thanks,
Thanks so much for having been with us today. Great to see you.
See you next week, folks.
Take care.